Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. As anticipated, the December corn contract found great resistance at the 360-degree level that we had that sat at 371, with a bit of confluence at the 373 half number. So as the price action hit this area this week, or last week rather, the market continued to find resistance there and finally met its match and decided to make a decline. Yesterday we had the WASDE report released. There were not much surprises there, but currently we're looking at potential support coming in for this contract near current price levels. We like support somewhere in the neighborhood of 354 to 361. In all likelihood, we'll probably land somewhere in between. And part of why we believe that is because the market is also overbought at this time. So if we're short the market currently, this is a good spot to perhaps start taking some money off the table, or even tightening our stops to make sure that we protect whatever gain we may have had to date. Also, you'll notice that as the market has made its advance, we're sitting at a retracement that is very close to the Fibonacci 61.8 number. And so somewhere between 61.8 and 78.6% is a good spot for this market to pause and perhaps make a rally and then another decline is the price action that we're possibly looking at to happen in the near term. It should not come as a surprise that the market found so much resistance at the 371 number, in part because the point of control currently sits at 389 3/4, and one standard deviation below that number is the 370 1/2 number, which is exactly where we found great resistance against this market. After it hit that area, you can see that volume at price really came in. Sellers continued to be heavy at that level, and at which point we see the market pushing back down, possibly with the WASDE report as a catalyst. But the reality is there had been massive resistance against this level for quite some time. The December corn contract shows us much of the same. Here we'll notice that we had our natural trend line coming in from the big geometric object, or the big geometric figure that we had applied onto the chart. We took that off and simply left some of the main trend lines for us to clean the chart up a bit. But you'll notice that as the market broke this trend line, this is where the decline began to happen, and currently we're sitting near volatility-based support, which coincides with being overbought in this market at this time. And so we would not be surprised to find some support near the 378 number for the December contract itself as the market comes in. If it's able to break below the 378 number, then we would look for the market to come down and test about 374 or so with regards to where the market would find its next key level of support. In addition to our volume at price analysis of the December corn contract, we have also overlaid a scaled price per day movement analysis as well. And what that enables us to do is to get a feel for what type of movement this market might make with regards to squaring out time and price. And what we mean by squaring out is when we find a balance with regards to how much a particular security has moved against how much time has transpired. Here you'll notice that the natural trend line that we've highlighted for you here acted as very great support the first time the market actually approached it. Once the market was able to break through that area, it has now become fantastic resistance. The market's come in and has now dropped from that resistance area, and we have a potential timeline of about February 17th for the market to potentially pause. That is, if this market is not able to get through this number or through this angle here. So it's going to be interesting to see how things play out with regards to it tracing out this price per day movement chart. For this December contract, the point of control sits at 391, and so the market failed here at that 391 area and has since dropped. One standard deviation below that point of control sits at 378, and there is a good chance that we'll find good support near that 378 number, at which point the market can make a small advance. The theme that we're seeing here for the soybean market rhymes with the corn market as well. The market has broken support. We're now sitting at volatility-based support here. The market is also oversold, so it's not unrealistic to anticipate a move to the upside with regards to a correction occurring after the nice little drop that we've seen here. We have a timeline of about February 11th for a potential low to come in, very close to where we are right now. So over the next couple of days, we would not be surprised to see the market either consolidate a bit or see a small bounce from this area. You'll notice here that the soybean contract has historically found great support near this 860 to 859 area, which is currently where it sits right now. The point of control currently is right at about 881, 882. The market has been trading in between this zone for quite a bit, and it will need to break out of this zone if it's going to find any strength in either direction. For now, we're looking for near-term support, which is one standard deviation away from the point of control. November beans has been trading in a tighter range, and it's been holding support very well. You'll notice here that the volatility bands are starting to point upwards, which indicates that the market is finding even a tighter range within which it wants to trade. In fact, the upper bands are also pointing downward, and so when this starts to happen, you'll start to see a bit of a compression with regards to the way the market's moving. And once we break out of compression, we can often see a nice, strong move breaking out on either side, potentially setting up for a nice straddle with regards to options trading. Here we find the market found resistance at the point of control, 889 and a quarter, and one standard deviation below that point of control sits at 872. So it would not be unreasonable to see the market continue to find great support at one standard deviation below that point of control. Once wheat broke our trend line, we saw a very fast decline occur, which is where we live right now. Markets are currently very extended, currently overbought, currently oversold, and we can see that the market is really touching at the extremes of our volatility bands. So at this point, we would not be surprised to see sideways or small bounce, but the reality is wheat is very weak. We have great supply and low demand, which does not make for a very good mix with regards to this contract at all. The market had been in a strong downtrend, and then we saw a small pullback, and we saw a small creeping trend, and now we are in our seventh leg of this creeping trend. Markets typically have 5 to 7 legs with regards to movement themselves, and so this seventh leg is probably going to be a very good spot for a terminal area for this near-term downtrend, at which point we could see a bit of a correction or continued sideways movement for this contract itself. As you'll notice here, the point of control of 497 3/4 was a perfect area for the market to top. We also had our additional analysis of price versus time squaring out. Once that occurred, the markets then declined, or we have broken through the contract lows for this contract. So at this point, we're looking for the market to really settle down, blow through, decide on where it wants to go, and then finally start to consolidate. In closing, we find that crude oil has fallen off the wagon again. Our previous support level of 28 and a dime is now being retested and being broken. And so now we're looking for a potential low to come in at about 24 and a half. And we anticipate that we should find significant support there, especially since the market now is approaching being oversold at the same time. We also have at about 26, 180-degree price threshold. And if it's able to get through this 24.5 number, then our next level of support would sit at about 21. But at this time, we really believe that the 24.5 should hold significantly for this contract. It bears mentioning that our same angle that we've been seeing has caused the markets to actually turn over, has worked once again, market tagged up against that level, and has since declined, and we're now breaking previous contract lows on this contract. Thank you so much for joining us for our session today. We look forward to serving you again next week for our weekly market update.